Hello, this is David Darst. Welcome back. I want to first recap some of the key developments in November. November turned out to be a loss-making month. The Standard & Poor's 500 declined 0.9%. Over 2.3% of it happened at the very end of the month. The Omicron variant of the coronavirus had been discovered in South Africa and was beginning to be transmitted in other parts of the world. We'll get back to that in a moment. The two-year Treasury interest rates went up by 4 basis points to 52 basis points, 0.52%. You had the short rates going up, and the 10-year and the 30-year rates went down. The 10-year Treasury closed at 1.43%, down 12 basis points versus the end of October, and the 30-year closed at 1.78%, down 15 basis points since the end of October. Gold, with interest rates going up on the short end, gold lost a little bit of ground. Gold was down 0.7%, just almost the same as the S&P was down 0.8%. Gold closing at $1,763 per troy ounce. That's down about 6% for the year to date. Oil, anything that goes down by 20% or more, they classify that as being in a bear market. And oil went down just over 20% for the month, 20.8% to $66.18 per barrel. Part of it was the announcement they're going to release some oil from the Strategic Petroleum Reserve of the United States and a few other nations. I don't think that has had much of an influence, as much as the worries that the variant, the Omicron variant of the coronavirus might be having on travel, on economic activity, and that therefore putting some downward pressure expected on the demand side for oil. China is up only 2.6% for the year. Europe is up 16% for the year, and Japan right now is up 1%. These are all in local currency terms. Now, the major developments of the month of November. First of all, President Biden reappointed Jay Powell as chair of the Federal Reserve Board. Markets seem to like that. It's continuity. He's a known factor. You may recall he was originally appointed to the Fed, not as chair, but appointed to the Fed by Barack Obama during his presidency, and was then appointed chair of the Fed by President Trump. So he has bipartisan support. He's a Washington veteran. He's pretty much respected, well-liked in town in Washington, D.C. So that was welcomed by the markets. And at the same time, President Biden appointed Lael Brainard as vice chair of the Fed. And very importantly, she's been somewhat critical at times of the banks, that they need to have more capital. In my humble opinion, in our opinion, the banks have plenty of capital and they're in pretty good shape. But she's been somewhat of an advocate of higher capital ratios required of banks. She's vice chair, but very importantly, the markets like this, she was not named vice chair of the Fed or governor in charge of bank supervision. She's vice chair, but not the governor in charge of bank supervision. So that the markets like. The second big development, of course, was the Omicron variant of the virus being discovered. And the three things we want to watch is, number one, is transmissibility. How contagious is it? The second thing is the severity. The third one is the responsiveness of the coronavirus variant, the Omicron variant, to vaccines and to therapeutic pills, okay? How responsive is it to booster shots? How resistant is it to booster shots? And how responsive to therapeutic pills? Then the third development of last month. So Chair Powell, the variant of the pandemic, of the virus, of the coronavirus. And number three is the Fed policy. Chair Powell said in some congressional testimony. He said, look, this could be inflationary. One, it could basically slow down the bottlenecks and the supply chain problems. It could slow down the resolution of these problems at the same time as it encourages people not to go back to work. And that keeps upward pressure on labor because the labor supply, there's great demand for labor, there's not enough supply, and people, you're going to see labor costs increasing. So therefore, he has said he's going to be in favor of perhaps the Fed accelerating its tapering. That is the amount of money that it's putting into the bond markets. It's going to reduce that, perhaps reduce it more than they're already reducing it, which is $15 billion per month. Markets right now are maybe thinking $20 billion a month or even more, so that the quantitative easing, the money printing to buy assets that the Fed and the European Central Bank and the Japanese Central Bank have been pursuing, for the Fed at least, that might come off more quickly. The final fourth big development of the month of November is the earnings season came to a close, basically, and it was turned out to be a very, very good earnings season, up 33% year over year. The fourth quarter, which here we are at the end of November in the fourth quarter already, the fourth quarter is estimated right now to be up 22%. The GDP forecast of the Atlanta Fed is up around 10% annualized. Remember, you had 6.3% growth in the first quarter, 6.7% annualized growth in the second quarter. Third quarter, 2.1%. And there's going to be expected by the Atlanta Fed, it's not 100% certain, that it would be up somewhere 8 to 10%. I've seen some forecasts of Goldman Sachs, Morgan Stanley, JP Morgan, others that are less than 8%. But anyway, that fourth quarter is supposed to be strong economic growth and about 22% earnings growth. Why only 22%? Because you're comparing against the recovery fourth quarter of last year. The first quarter of the coming year is expected to be only 6%. So when you get done with it, the full year 2021 is expected to be up 44%, and 2022 is expected to be up only 9%. So please take note, we're expecting some slowdown in the rate of growth in earnings, still positive, but much slower than it was. Let's talk now about this tapering and inflation and interest rates. This is called a yield curve. Short interest rates are low. Longer interest rates, 7-year, 10-year, 30-year, are higher usually than short rates. If we get a flattening, look, this is what happens. The short rates come up and the long rates come down so that it looks flat now. That means that the market expects the Fed to tighten. It's raising short rates, and the long rates go down because that's expected to basically somewhat influence the economic recovery of next year. Higher interest rates somewhat negatively influence, not negative growth, but put a dampener on the growth next year. So if we see the yield curve do this, that means the Fed is on the case and they're beginning to pump the brakes. However, if instead you see, look here, here's normal. Instead, you see the long rates going up and the short rates staying down. That means the Fed is still hitting the accelerator. They're hitting the petrol. They're hitting the gasoline. And it's not, they're falling behind the curve as far as inflation. That's the answer. So far, you've seen this distance here has gone from about 150 down to around 80. So it's holding there. The market is watching. Will it go that way or will it stay here or go back up? That's the key. Now let's talk about positioning here. You're going to watch on December 3rd, that's Friday, that's next Friday, you'll see the jobs report. Most people are looking for a jobs report of somewhere around 450,000. I think it could be less because of this variant, the Omicron variant of the pandemic, of the coronavirus. But we will see how that one comes out. The second thing that we'll be looking for as far as positioning will be this December 14th and 15th Federal Reserve meeting. You'll see there what will they begin to reduce or increase? Will they increase the tapering? Will they begin to continue to reduce the amount? Are they the 15 billion, will it become 20 billion? Will it become 25 billion? That they reduce the amount of money printing that they're doing every month. The third thing will be what will Congress do as far as the budget? What will they do as far as the debt ceiling? And that may be pushed over into the new year. The debt ceiling, but will they pass a budget? We expect they will, and those are the three things: the jobs report, the Fed meeting, and what will Congress do. Now let's wrap up talking about building blocks and stumbling blocks. This is very similar to what we talked about last month. The building blocks: number one, monetary stimulus. If you had 0 to 10, the monetary stimulus used to be a 10. Now it's maybe a 7. Okay, it's still positive, but it's less than it was because we've started this tapering of the bond purchases. The second is fiscal stimulus. It's still a positive. Why is it more of a positive even though the spending is not as much as it was back in late 2020 and early 2021? Why? Because the tax increases are not nearly as severe and as onerous and as burdensome as people were originally fearing. So I would say if 10 is maximum strength of positive from the fiscal side, I'd say we've come down to maybe a 4. It's still positive, but it's no longer that full-blown pedal to the metal, very strong impetus. The third one is the economic growth. How's the economy doing? And there it's doing blockbusters. Retail sales, ISM manufacturing, ISM services. You have all kinds of indicators in the economy right now. Confidence is high. It's come down a little bit, but it's still quite high. So there, the economy is going very, very well. I just mentioned these big numbers that are expected for the fourth quarter. Then you have the vaccines and the fight back against the pandemic, the fight back. On the pandemic fight, there we've had the vaccines. So a few months ago, when we first were getting the effects of the vaccines and everybody was opening up again, I would say we were at maybe an 8, okay? During the depths of the despair of a year ago, maybe you were at a 2 or a 3 or maybe a -5 or a -6. So we swung all the way over to maybe a +8. Then we dropped back somewhat. And right now with this variant of the virus, okay, the Omicron variant, I would say maybe you're still positive, okay? You're still positive because it does not seem to be as severe. It's more contagious. It does not seem to be as severe, and they are working like crazy. They know how to create vaccines. They know how to create therapeutics, okay? So this, I would say, until further notice. And look, we don't know it's all in people's minds right now. They're worried, but we think that it can be contained. So I would say that's maybe a 1 or a 2. It's still positive. It's a 1 or a 2. And the last one is liquidity. And there I would say that's a 9 or an 8 out of 10. The liquidity, the amount of money that's there. And it's not only consumer money, and it's not only business money, it's not only household money, it's not only individual money and corporate money, it's also central bank money, and it's sovereign wealth fund money. And as you've seen over the years, over the last few years, they have begun to put money, believe it or not, into stocks. You have certain central banks that their largest holding is Apple, okay? This is not currencies. This is not gold. This is not bonds. It's common stocks, and it's tended to be U.S. common stocks. So I would say that liquidity force is still there and still very, very high. The stumbling blocks, valuations are high, okay? Concentration is high. Euphoria and good feelings are basically high in many sectors, not everywhere, but in many sectors. Inflation has come up. Our feeling is it will come down next year. It may not come down as soon as the people were hoping, but we think it will come down next year. And finally, the last one is the debt ceiling drama is probably going to be pushed over into the new year, January or February, and that has not gone away yet. So we wait to see how that comes out. Speaking of which, let me just wish all of you a very, very happy holiday season, a great start to December, and a wonderful beginning of 2022. And we'll see you next month.